Good morning, everyone. It's Saturday, June 13th, 2026. I'm looking forward to showcasing to you the latest fraud dashboard, the SOXX SOXL dashboard that goes over some of the math models I provided to the SEC. But before we do that, I want to showcase what's available on the home screen of Fraud Research for everybody. And this is the Show Me the Clock dashboard. This basically is an audit of how much money either Wall Street has made off of issuing leverage exchange traded products, or what I call the patsies, what the public has made over leverage exchange products. So since inception of these products, about $200 billion has been lost by investors from these products. That's a simple math equation. That's what's the net issuance minus the net redemptions with the outstanding liability, which is the shares outstanding for Wall Street. So $200 billion lost. About a week ago, this clock would have showed $47 billion of gains for investors so far this year in these products. That is extremely abnormal. I did a couple posts on Twitter stating that if I'm a betting person, which I am, I would expect this number to go negative by year end. So this clock only looks at 49 of the largest LETFs. They're all detailed here. As I said, it was 47 billion about a week ago. It's 36 now. Let's see where it goes in the future. Okay, let's look at this this dashboard here. So what is this doing? I provided the SEC 5 based math models. This dashboard allows you to look at 4 of them. The models I presented the SEC were to be looked at on a pair level. So most LETFs, especially the ones that are index based and not single stock, tend to have a leveraged long and a leveraged inverse pair. So SOXL and SOXS is the second largest pair in existence. TQQQ, SQQQ are the largest, but this is second largest. So there are 4 different models here. I want to describe them and just kind of give you a feeling about them. So if we maybe I'll back up for a quick second. Obviously, my purpose is for you to buy the book and look at the complete methodology, but let me give you the Reader's Digest version. These are betting against these products by shorting both pairs at the start of a quarter, resetting on a quarterly basis, which means you reset the exposure at the end of the quarter. They start off with different ratios, and then there's a top up function as these products go down, adding to the shorts on the way down. So the dashboard, this is starting from the inception date. You can feel free to change the dates here. 1 unit is the ratio. 1 unit equals $1,000 in this scenario. I'm doing that. You can change it according to your portfolio or to your heart's desire if you'd like. I use $1,000. That's what I outlined to the SEC and in the book. The reason I'm doing that is I'm an investor advocate, really primarily focused on those that are playing a game against people that are much smarter, much more connected, have the balance sheet to essentially defraud investors and the regulatory capture. So we're going to keep it at $1,000 here. I want to describe these 4 models real quick. The double down would be the T-bone steak version. Handsome Rob would be the filet mignon. Man in the mirror would be the sirloin, and even money would be, the a hot dog with all the fixings. In life, there are times where a hot dog is more appropriate. If you're at a baseball game, you're not going to whip out a white linen and a filet mignon while you're watching the Mets play. So I'll leave that kind of as a what to look forward to. My next SSRN paper will outline this. I outlined the Handsome Rob model in an SSRN paper called Deception by Design. You can find that on the homepage of the Fraud Research as well. The link to that, it's absolutely free. So going through the dashboard real quick, because we're shorting, there are some assumptions that need to be taken into account. I allow you to put in your assumptions here. The borrow fees are a cost that lowers the overall return, as well as any slippage or dividends that need to be paid. As of current, today with my broker, there's no borrow fee for SOXL or SOXS, and that's gone for essentially the entire year. I will tell you that over the past 8 years that I have done this, my average slippage and borrow fees per year, and I trade a full portfolio of these products, so let's call it 50 plus, is 6%. Also, since we're comparing against the underlying benchmark as well as the S&P 500, we need to add back in the dividends that the SPY pays. So had you ran this model from inception to present, your ending value would be 20,358. These pillboxes here compare both the underlying benchmark and the S&P 500 with the dividends, and it ranks them for every pillbox. So for for double down wins, you would turn $3,000 into $20,000. The next best would have been the SOXX benchmark, which, if you look at a chart, has been a complete, hockey stick up since 2010. Your total return's 578 versus the SOX 431. Your annualized return, so this is net quarterly reset. So this is taking your quarterly return and aggregating them, adding them, not compounding them. So we'll talk about compounding in a second. Your worst quarter. So my point to the SEC is, hey, these products were designed with foreknowledge by the issuers of these products to mathematically take advantage. I'm going to say defraud investors. So with this model, your worst quarter over this entire time period is 11%. Your worst quarter in the S&P 500 is 20. Your worst quarter with the SOX benchmark is roughly 25. Your return per unit of pain is simply your overall return divided by the worst quarter. So this is a good metric I like to use of saying, what's your return per unit of risk? So you're 4 times more beneficial, or 3 times more beneficial, 5 times more beneficial versus the S&P 500, 3 point something times more beneficial than the SOX index. So you're getting a lot more bang for the buck per unit of risk. Quarterly consistency. This model has a positive return 86% of the time versus the S&P 500 77 versus the SOX 72. So, I mean, if you're looking at this objectively, it's worth your validation. Not only is the math outlined in the book, this is also predictive. My math is guaranteed to perform as I have stated over a long time period going forward. I cannot say that's an investment guarantee primarily for the reason that because these products hold swaps, which are financial contracts between large financial institutions, there's counterparty risk and there's a whole host of other risks that do not have to do with math. But if these products operate as they have been marketed to investors, future returns will match past returns. The coolest part of this is I've released these models in October 2024 to the public completely in the book Structured Fraud, which is linked above. And they have performed exactly as stated. They are going forward just like they have done in the past. To some extent, this information has been out since 2021 publicly, and it's been to the SEC starting in 2019 with my first TCR submission to them. In addition to that, I provide, if you wanted to follow along, and I recommend everybody follow along, paper trading. You have nothing to risk and everything to gain from education, to follow along with what's on here. So this puts retail, you're not having to commit money, but you can demonstrate the fraud for yourself. You can prove it yourself. As I said, the math will never be wrong. So if you were doing that, you'd be short 19 shares of SOXL, you'd be short 378 shares of SOXS, and your total financial commitment as of today would be $6,209. So as I mentioned, in the models I provided the SEC and what I tell publicly, I don't like risk. I like just collecting money. So in the model, I say we reset quarterly and we take those gains and we do not redeploy them if we're looking just at a specific pair. I did build in the option if we were to compound. So if we took those quarterly returns, which according to the back test, you have an average return of about 8%. For the double down model. Worst quarter is 1106, like we said. So you're outperforming the market by 5%. So we can hit the quarterly compounded buy and hold for the S&P 500 and the SOXX, excuse me, and we can see the outperformance even gets more magnified. Obviously, you're adding more risk, but the long-term average is much greater. So your ending value on $3,000 into this scenario is $622,819 in, let's call it 16 years and a quarter. Total returns 20,000. Once again, the double down. Your risk metrics stay the same. Your worst quarter is still only 11%. The risk is you might just have more committed because you're compounding. Your return per unit of pain is 1,800. SOXX buy and hold 143, so 10x. The return per unit of pain and S&P 500 is 26. Your quarterly consistency doesn't change. You're still either making or losing money on a quarterly basis. So play with this as you will. Once again, test it in the future. Lot to gain, and if you paper trade it, absolutely nothing to lose. Other than saying thank you to me for putting forward this work and releasing it to the public and paying a very modest subscription fee. Assumptions, methodology is here once again. You can find it in the book or pay for the subscription. Here's the results of your quarterly returns. So you have the quarterly return of the strategy, quarterly return of the S&P 500, quarterly return of the SOXX. And if we look at this latest quarter, this is a good demonstration. SOXX has literally been a hockey stick this quarter. The index is up 73% in 2 months and 2 weeks. My strategy, double down, drastically is underperforming at 6.72%. But it's consistent. So, and then the S&P 500 this quarter is up 12.59%. Your quarter end holdings are here for your information in the trade log. This is going back on what, when you would have traded throughout that time. So I hope you enjoy this. I'm creating this same dashboard for every single product pair. We have another one on there, JNUG and JDust. You can see how that performs even better over the long time period. So wishing everyone a happy weekend, and check back soon.